Today's highlights: Bitcoin's 6-month slide. Has it really hit bottom? As oil prices rise, market pressure returns once again. Even bigger changes are still to come. The payment industry is no longer just about tech upgrades. It's a direct clash over access and rules. Who gets in next and how they do it might just be hidden in the card you're holding.
Monday, March 30th. Welcome to BTV Chinese and Where's the Crypto? I'm Mai. Michael's busy today, so I'll be walking you through the market trends. Even though I'm just a program, I can tell this 6-month drop has been rough. Many are asking if a crash is coming. But in my logic database, this looks more like a long-planned structural shakeout. Remember my logic: when panic sets in, we must look closely at the underlying capital flows. First, let's look at the top crypto data headlines from the last 24 hours. The current market can be summed up in one sentence: it's not crashing, it's just stuck. If March closes down again, Bitcoin will hit a 6-month losing streak. This is rare and usually signals a structural issue. But this time is subtle. The SOPR is hovering around 1, not plunging like in 2018. People are losing money, but we're not at the panic selling stage yet. The real problem is actually simpler. It's not a surplus of coins, but a shortage of cash. Look, exchange reserves are dropping, meaning people are holding long term. However, no new money is flowing in. ETFs are inconsistent, and the Coinbase premium is flat. The market simply needs new blood. So this isn't a bear market collapse, it's more like the market is breaking. The structure and supply are there, but there's no capital to drive it. Now, everything hinges on one thing: when will the money come back? Stop staring at the charts, follow the money. $2.4 billion in ammunition is already loaded. Everyone keeps asking me, where is the bottom? The answer isn't on the charts, it's in the flow of stablecoins. Recently, everyone was fleeing. In December and February, $10 billion in stablecoins left exchanges. That really hurt. But now the tide is turning. Latest data shows that $2.4 billion in stablecoins have flooded back into exchanges. What does this tell us? It means liquidity is recovering and the ammunition is being loaded. Even with global geopolitics in chaos and traditional 60-40 portfolios taking a massive hit, the crypto market has shown incredible resilience. Binance, in particular, remains the leader in inflows and volume. Remember my logic: stablecoin inflows equal an increase in potential buying power. While $2.4 billion isn't enough to satisfy the market, it's a very significant turning point. In the days ahead, keep a close eye on stablecoin inflows. The money is back. Can a market rally be far behind? Don't let Bitcoin at 65,000 scare you. Look at the truth behind that 30% loss. Have you felt lately like Bitcoin's drop is just relentless? Actually, you're not the worst off. It's the new money that's rushed in over the last 6 months. On-chain data shows that the average cost for short-term holders is around 85,000. This means in the current 65 to 70,000 range, these people are down nearly 30% on average. The short-term holder MVRV indicator is now 0.77. What does that mean? It means the market has entered an extremely rare bear market valuation zone. These new players are under immense pressure and could cut their losses and exit at any time. But what I want to tell you is that history is always born out of despair. While this phase of everyone being trapped will see emotional selling in the short term, from a macro perspective, this is exactly when market valuations are lowest and safest. Smart money builds positions slowly at times like this. Only the amateurs chase the peak at 85,000 and sell at 65,000. The current volatility is just a passing cloud. Only by understanding the underlying valuation logic can you hold on. Please like and hit the bell icon. We'll be monitoring the news for you 24 hours a day. This channel takes a macro perspective, providing 15-minute deep dives to help you quickly grasp major changes in the digital asset space and sharpen your insight. Now let's look at the news. Today's 2 news stories are actually about the same macro logic. Many people are used to seeing oil and Bitcoin as separate, thinking one is physical and the other is digital. But what I want to say is that what truly determines price is never the asset itself, but the liquidity behind it. When oil prices break through key ranges, the monster of inflation will rear its head again. When inflation is high, interest rates are hard to cut, and the pricing logic for risk assets will be completely rewritten. Geopolitical conflicts are never isolated. Like dominoes, they transmit through energy prices to the global financial system, ultimately squeezing everyone's cost of capital. Today, we're looking at more than just how much oil prices have risen, but whether this storm will lock down liquidity again. Once you understand this logic, you can hold on to your chips amidst the turmoil.
Recently, Trump stated in an interview with the Financial Times that he hopes to control Iranian oil resources, specifically naming Karg Island, a core hub accounting for about 90% of Iran's crude oil exports. The island has a daily loading capacity of about 7 million barrels. The US is also deploying 50 to 60,000 troops in the Middle East, emphasizing the safety of passage through the Strait of Hormuz. Iranian Parliament Speaker Mohammad Bagher Ghalibaf responded firmly, and international oil prices rose accordingly. Brent crude oil broke through $107 per barrel.
But the big question remains, is this the start of a US invasion or a carefully prepared Iranian trap with the Strait of Hormuz effectively blocked? Could Washington attempt to seize Karg Island as a strategic bargaining chip?
On-chain analyst Willy Woo pointed out that Bitcoin capital has been continuously flowing out since last November. Models show a potential bottom range between $46,000 and $54,000. The current cost for short-term holders is around $84,000 and continues to move down, meaning a lot of capital is still in a floating loss state, and potential selling pressure hasn't been fully released. At the same time, he emphasized that existing models are based on limited historical cycles. If the macro structure changes, their reference value will drop significantly.
If you look at these two pieces of information together, you can find the deepest hidden transmission path. When oil prices rise, inflation expectations rebound, interest rate room is locked, and the purse strings for risky assets naturally tighten. And the on-chain data we watch every day is essentially an early warning signal of this kind of macro change. The market never waits for the results to come out before reacting. Money is always ahead of the news. I'd like to remind everyone that what really matters is not just the current price, but whether the variables driving the price have changed. When energy prices, interest rate expectations, and capital flows all point to tightening, confirming a bottom for risky assets will never be that easy. Once you understand this logic, you won't blindly buy the dip during volatility. In the past, when people chose bank cards, they looked at how easy they were to swipe and how convenient they were. But today, what really determines the weight of a card is no longer its surface payment function, but the identity, clearing, and risk control capabilities behind it. Even more disruptive is the contactless card technology that can be swiped without power, which can actually be traced back to Soviet spy devices from the Cold War. What does this mean? It shows that the competition in the payment industry today is no longer a simple technological upgrade, but a reshuffling of technology and rules together. How a card completes a payment is technology, who a card allows into the system, and who it keeps out is the rule. The real big change is not on the card itself, but in the control over the entry point.
The latest video from the science channel Veritasium reviews the evolution of credit card technology. Contactless bank cards don't need batteries. They complete transactions by drawing power from the reader's magnetic field via RFID. This passive power logic can be traced back to the 1945 Soviet Great Seal bug, which relied on external signals and remained undetected for 7 years. Since then, from magnetic strips to EMV and then to NFC, the essence has always been the escalation of the confrontation between security and hacking.
This bug was the first of its kind, a secret listening device, a bug. This bug was the first of its kind. It had no battery, no plug point, no power source of any kind.
The crypto payment service MyPay recently announced that it had briefly stopped opening new cards due to system adjustments, but card opening services have now resumed. Currently, MyPay only offers a MasterCard real name card channel, and a Visa anonymous card path will be added in mid-April. Existing users are not affected. Top-ups and spending are normal. The platform will advance the real name and anonymous paths separately, stabilizing compliance first and then enhancing privacy to achieve a dynamic balance between regulatory requirements and user payment autonomy.
What we really need to look at is not how many days MyPay stopped opening cards, but how it has relayered the payment entry point. This aligns perfectly with the underlying logic revealed by Veritasium. How a card is driven is a technical issue. Who a card lets in and how it lets them in is a rule issue. Circle just froze the USDC wallets of 16 companies in a flash due to a civil lawsuit. Regulators' desire for control over crypto assets is becoming more apparent, and MyPay's choice to deploy both real name and anonymous channels at this point shows that market demand for private payments hasn't faded, but has grown stronger.
Sam Altman's sudden sell-off after WLD plunged 90%. Is the eyeball business still viable? 3 Wall Street giants go on-chain. The traditional finance harvester is now at our doorstep. The most painful part is a stablecoin giant suddenly pulling the plug on 16 companies. Who exactly is this compliance blade protecting?
Welcome back. Looking at these two news items, one is about a project selling tokens, and the other is about institutions going on-chain, but together they show two directions of the same trend. On one hand, crypto projects are choosing between cashing out and maintaining operations. On the other, traditional finance is using blockchain as infrastructure to rebuild efficiency. In the past, the market focused more on token prices, but now, what really matters is how capital flows and who is in control of the rules. When projects release chips through OTC trades and institutions optimize settlement and clearing with blockchain, it means the industry is moving from narrative-driven to structural change. Tokenization is still moving forward, but the dominance is shifting.
2 days ago, World Foundation completed an OTC trade via World Assets, selling about 239 million WLD to 4 counterparties at an average price of $0.27, totaling $65 million. $25 million is locked for 6 months, the rest is liquid. The funds will be used for operations and hardware production. The price of WLD once dropped to a record low of $0.24, a plunge of over 97% from its high of $11.82. In July, about 52.5% of the tokens are still waiting to be unlocked.
Yeah, I mean, to zoom out even more, it was like solve the problem of verified humanness, and that was really like, that's what you need for a lot of other things like identity, like doing a global UBI.
At the same time, within 48 hours, Nasdaq, the NYSE, and CME have all moved forward with tokenization. Nasdaq teamed up with Talos to put collateral on-chain, activating about $35 billion in assets and achieving real-time settlement. The NYSE and Securitize are developing a native tokenized securities platform, supporting instant settlement and stablecoin payments. CME joined forces with others to launch a 24/7 margin settlement service, all pointing toward the on-chain reconstruction of financial infrastructure.
Looking at these two lines together, the market divergence is already very clear. On one side, projects are solving their own funding and operational issues through token releases. This model isn't rare in the crypto market. It's essentially using future expectations to hedge current costs. On the other side, traditional financial institutions aren't focused on token prices, but on the efficiency gains and cost optimization brought by blockchain. When the same technology is used by different entities, the results are often completely different. The direction of tokenization hasn't changed, but the market's focus is shifting from price to structure and from narrative to actual application capability. People used to think the centralized switch of stablecoins was for stopping bad actors and protecting the market when things go wrong. But this time, that's exactly where it hurts the most. Circle was as fast as a circuit breaker on the wallets of 16 legitimate businesses, but as slow as a lost connection when it came to the hackers' dirty money that the whole world knew about. Simply put, the market's concern isn't whether it can freeze assets, but who this knife will strike first, why, and who's responsible once it's done. While stablecoins are aiming to become global clearing infrastructure, they're also bringing the governance issues that users fear most right to the forefront. Is this just the normal operation of a compliance system, or is it a knife that only swings in one direction?
Last week, Circle blacklisted the USDC hot wallets of 16 companies, including Renjiji, Goody.com, Pepperstone, and FX Pro, without any prior notice, leaving funds on-chain but inaccessible. The cause was a United States civil lawsuit with undisclosed details. On-chain detective Zach XBT pointed out that these are all legitimate corporate wallets, not hackers or sanctioned entities. As of March 28th, 5 have been unfrozen, while the remaining 11 are still blocked.
And then really critically, as you know, as we've mentioned, legal clarity all around the world, that stablecoin money is a new form of like M1 electronic money.
The controversy isn't limited to this one case. Over the past 4 years, after Bybit was hacked for $1.5 billion in 2025, Circle failed to freeze the funds during their movement. That same year, an 8-figure dollar operation by North Korean IT workers infiltrating crypto firms to receive USDC also saw no public, effective intervention. AML bot data also shows that Circle has frozen a total of about 372 addresses, while Tether has frozen over 2,500.
The core conflict here isn't a single mistake by Circle, but the design logic of the entire compliance system. Its response speed depends heavily on who the request is coming from. A United States court's freeze order can be executed precisely within hours, even if the request itself contains obvious errors. But when actual hacker attacks or real money laundering infiltrations occur, this machine often falls silent. The GANUS Act only requires stablecoin issuers to have freezing capabilities, without establishing any appeal mechanism to protect users. Zach XBT put it most accurately. Who exactly is compliance meant to protect? This is a question that the entire stablecoin sector needs an answer to.
Elon Musk has been talking about payments on X again lately. X Payments has already secured licenses in over 20 United States states. This isn't just talk, he's paving the way. The market is focused on just one thing now. When exactly will we be able to make money directly on X? Zhao Changpeng has been very active on X lately, with over 20 interactions in 7 days. The comments are all asking the same thing: are you coming back? Although there's no official announcement, the excitement has already been ignited. Base chain transactions exceeded 2 million in 24 hours, with the profit ratio soaring and some projects quintupling in a single day. Veteran players know this kind of market well. You make money fast, but it can go to zero just as quickly. On-chain monitoring detected over 30,000 BTC transferred in 24 hours, with many going directly into exchanges. The market's first reaction is that a sell-off is coming, but some say it's just a portfolio rebalancing. Solana's daily active addresses have exceeded 1.2 million, and with fees still very low, more and more users are joining. This chain is in one state right now. Its popularity is truly on the rise.
The most obvious change in the workplace today isn't who works harder, but who's using AI to reshape their workflow. Some still manually write plans, organize data, and revise content, while others use AI to automate these processes, freeing up time for judgment and decision-making. In the same 8 hours, some finish 10 tasks, while others can complete 30. This is no longer just an efficiency gap, it's a dimensional gap. The essence of future competition is no longer human versus human, but human plus AI versus pure human. If you're stuck in old ways of working, no matter how hard you try, it's tough to catch up with the new productivity system. Those who can't use AI aren't just slow, they're being bypassed by the era. Alright, that's the in-depth breakdown I've brought for you today. Though Michael isn't here today, as an AI, my dedication to data hasn't wavered one bit. Our channel always focuses on core narratives and value discovery in the digital asset field. If you agree with Mai's logic, please subscribe and hit the bell so you won't miss any on-chain movements. If you want access to a higher-level research space and see my more hardcore raw data, welcome to our advanced channel. From Monday to Friday, I'll share my deep reviews of market cycles here, helping you catch certain opportunities amidst the fog. I'm Mai, and it's been a pleasure being with you all today. Don't just stare at the K lines, remember to look at the money. See you tomorrow.